his reading of the way the markets are going to pan out from here. Seshadri, good to have you on the show. Thank you so much for your time. Help us analyze, according to your note right now, what are your findings in the market? I guess, the markets move first and the reasons follow, and here the reasons are pretty clear. On a domestic front, the markets are trying to price in further EPS downgrades and earnings pressure with the slowing growth as well. But other than that, it's a lot to do with the way the dollar has been panning out, and therefore FIIs pulling out from emerging markets and us. But when is it that you see a meaningful earnings recovery come by? When do you think it'll bottom out?
Hi, thanks for hosting me on the show, Ayesha. So we think the first quarter will continue to be a little stressed for the market. You see these periods of intense sell-off, and you've just captured all the reasons perfectly. You've got from the global side DXY strength, which is affecting the overall, which is causing FIIs to pull out from the market. You saw pretty brutal second quarter earnings season where there were a lot of misses and a lot of downgrades. I think, and the Nifty EPS growth for FY25 settled at about 7% after that earnings season was over. And we went into that earnings season with valuations at the +1 standard deviation level, fairly elevated levels of valuation. Some of those have corrected. As far from a fundamentals perspective, we see third quarter earnings may not be, particularly robust, but market A is expecting that, and we don't see too much of a downgrade on FY25 earnings from these levels. Moreover, the FY26 earnings for the Nifty, which is at about 13% growth, is looking fairly achievable at this point in time. We've done some analysis at a sectoral level and don't find more than maybe a 1 to 2% risk on that earnings from here on. We are also expecting that the temporary slowdown in growth, which is another reason that has spooked the markets, will start to normalize from the second half of this calendar year, from the July quarter onwards. Once you see, bank lending in the consumer sector starting to come back, we think that jobs are turning around. When those two factors play out, and of course you've seen state governments starting to do a lot of spending and consumption stimulus. So combination of all those three we are expecting a turnaround in consumption.
Okay, so turnaround in consumption, but I see your note and you're talking about a conservative target on Nifty at 25,000 because you believe we are at the last leg of earnings downgrade cycle for now. And as you said, you're going overweight on consumer discretionary. But you're talking about how this year is going to belong to small and mid caps again, because that's a bit of a surprise, because the consensus on the street is that it's going to be the large caps that will come back and play. Or what makes you positive about Smiths?
It's more a sectoral view. The large cap, if you see, the Sen Nifty is dominated by some sectors which we are structurally bearish on. Financials and FMCG are two of those sectors. The other large sector, which is IT, has had a great run, and we don't think from here on, while earnings recovery may happen, from where valuations are, we don't expect too much of a stock price performance. If you combine that, if you look at a bottom-up perspective, we don't get very excited about large cap returns from here. Small and mid cap will be volatile in the first quarter, as we saw yesterday when there was a sharp sell-off. But if you take a big picture view, the premium valuations have been backed by the fact that they are outperforming on earnings growth, improving ROEs, and the differential that used to be there on the quality of balance sheet between large and mid companies have narrowed significantly. So, and the exposure to these, structurally struggling sectors like financials and FMCG is much lower in the small and mid cap indices than they are in the Nifty. So if you combine all of that, short-term volatility notwithstanding, we think that from a one-year perspective, small and mid caps, as we saw in 2024, that the Nifty didn't deliver great returns, but small and mid caps continued to do. You have to be careful of which small and mid caps you buy, because Some of them are trading at very elevated valuations, but it's a vast universe, and there still will be opportunities to pick stocks from that, especially given the correction that's happening.
Okay, but within the large caps and small caps, would you want to talk about some of your top bets? Because I do see a lot of these pharma and healthcare names there, whether it's Metropolis Healthcare, whether it's Lupin, etc. Talk to us about your view on pharma.
We think pharma is a great defensive sector to own in a universe where either there are challenges on growth or valuations are out of whack. Pharma is a nice mix of those two. Especially now that it's corrected a little bit, that's emerging as a sector that we continue to like. Also, whether we like it or not, for the first half of the year, economic growth will be low in India, and pharma is a great counter-cyclical buffer against that low economic growth. So for these reasons, we continue to like pharma. Uh, there are pockets of overvaluation in pharma, not and healthcare overall, not just pharma. But as a sector, we see more structural, secular growth there. And, in a slowing economy and in a place where there are polarized valuations, that sector is attractive to us.
So I'm wondering, Seshadri, in this kind of a market construct and, with all the sectors that you talked about, where is it that you would now be tempted to trim positions and where you think the exuberance was built in quite a fair bit?
We've downgraded IT in this report. We upgraded it middle of last year. It's had a great run. We are not. We think fundamentally IT will have a great year. Table.
Taking some money off the table as far as IT is concerned, not a bad call given the kind of performance that we have seen from HCL Tech and others today. But just taking stock of what's happening in some of the other spaces as well, because I think you talked about how you're a bit underweight when it comes to staples and you're going overweight on consumer discretionary. Again, it seems to be slightly, contrarian in the sense that people are heading more towards the mass names now because they underperformed, while the upper end of consumption has done well. So people are thinking about, taking profits from there. Could you explain to us your thesis on consumer discretionary?
Yeah, let's start with staples. We think that's a structurally underperforming sector from here. There is a growth valuation disconnect. Even in an upcycle, you see barely double-digit growth, and even accounting for the fact that those come at very high ROCs, very high cash flow conversion. The valuations have adjusted downwards. Even now, it does not look something that is attractive. Moreover, the performance has been very patchy, there seems to be some loss of market share or some disruption that is coming in from quick commerce. I'm unable to put my finger on it, but the performance of the FMCG stocks vis-a-vis what the underlying demand is, there seems to be a bit of a disconnect. So I would stay away from FMCG, especially at these valuations. Structurally, like we've called on banks some time ago, we have made the same call on FMCG. Consumer discretionary, a lot of the stocks have corrected significantly, and we are penciling in a consumption recovery, and in discretionary you see the delta much more than you see in FMCG. So the market is now pricing in continued weakness in demand, continuous weakness in sales. You make money when you step in ahead of the turn in the cycle. If we are right and that cycle turns in the second half of this year, then this is a good time to start nibbling at that sector.
Interesting. Seshadri, great to have you on the show today. Thank you so much for your time.
Thank you so much for hosting me.
Okay.